on economics and finance too. I think there are multiple sections of this topic, so that's why this is number 2. The first speaker is Ladislav Kristoufek from the Institute on Information Theory and Automation at the Czech Academy of Sciences and the Institute of Economic Studies and Faculty of Social Sciences at Charles University in Prague in the Czech Republic. So Ladislav, the floor is yours.
Yeah, thank you very much.
I suppose I need to say something about the rules, but you have 12 minutes approximately, and then we will have questions and answers, and total time for a presentation is 15 minutes.
Yeah, thank you very much.
Go ahead.
Good evening. Welcome to this presentation. It's on the role of stablecoins in crypto assets pricing dynamics. As was said, and as you know, 12 minutes is not a long time, certainly. So I will try to be brief. And at the end, there is a link to the preprint that you can check if you're interested in the details. Hopefully, my kids will not run in. Well, we'll see how it goes. So to begin, stablecoins are usually token-based crypto assets pegged mostly to standard currencies, mostly US dollar. There are also commodity-backed ones and cryptocurrency-backed ones. And their main objective is to enable easy transactions between different exchanges with stable exchange rates. So it doesn't fluctuate or shouldn't fluctuate much. And it bypasses, or it's supposed to bypass the inherent crypto assets large volatility, so that you don't trade just in Bitcoins or something, but you have the tether and you can transfer it quickly, and you are quite sure that the exchange rate of that one will not change a lot during these few minutes. The research itself into stablecoins has attracted only little attention up till now, even though their importance certainly grows, because Tether, or USDT, the largest of the stablecoins, is now the third most capitalized crypto assets, only after Bitcoin and Ethereum. So it's the third largest one. Several studies suggest that stablecoins have played an important role in the bubble episodes of the crypto markets, mostly in 2017. And there is this paper from 2020 in Journal of Finance that talks about it. So even in the very mainstream and very top-notch journal, there is this kind of argumentation. Even though it took a very long time, it's a paper original, I think, from 2018. It took quite some time. It was quite controversial. I mean, there were some, the authors were sued or something by Bitfinex or something. So it was quite crazy. Anyway, so the aim is to inspect the claims that stablecoins are some kind of bubble boosters, so that they are boosting the price bubbles, but also to focus on larger pool of stablecoins and larger pool of crypto assets in general. And as we have limited time, this will be quite quick. So the data set is the following. So first part are the stable coins. So I collected all stable coins with market capitalization of at least $1 million as of July 2020. That gave me 28 stable coins. And majority of such stable coins are pegged to US dollar. Some of them are pegged to euro. And there is one that is pegged to Swiss franc, and one to Chinese, to renminbi. Around 80% of the overall stablecoin capitalization is made of Tether, so the largest one, which leads us to the selection of the starting period based on this USDT data availability. So we go back to March the 6th, 2015. So still quite long period. So overall, we have almost 2,000 observations between March 2015 and July 2020. For the other crypto assets, so non-stable coins, I take top 10 without USDT crypto assets with respect to the market capitalization as of July 2020. I also added some popular, let's say, old-timers that are not in top 10 at this moment, but they were very popular in 2017, and they have some history. So Dash, for example, if you're aware of these or the other altcoins. So overall, we have 14 crypto assets, and they cover around 90% of the overall crypto market capitalization without stablecoins. I also try to take the overall market capitalization series, but it's quite problematic at various sites. There are jumps that are not reasonable, and it's quite problematic. So I opted for this to actually pick or to take the largest ones, collect them together, and then sum them, so that in the end we have some proxy for market capitalization of the altcoins. If we put it into a graph, so you see it runs in time from 2015. It's a semi-logarithmic scale of market capitalizations. You have the overall crypto assets, which is the red line. Then you have Bitcoin. You see it's still a very large proportion, around 50%. Almost all the time or close to it. Then we have altcoins, but you see that the gap between altcoins and Bitcoin really squeezes. At the peak during 2017, it was quite tiny. And actually, when Bitcoin was dropping in 2018, it got, or the market capitalization or the Bitcoin dominance was below 50%. And then we have stablecoins, the purple color, and USDT in gray. You can see that USDT forms a huge portion of the total capitalization of these. You see that only by the end of 2018, there are some other stablecoins that play a role that have some larger market capitalization, but still USDT is by far the most important one. If we standardize these series, so if we detrend them, so we take the first logarithmic differences, demean them, and divide by the standard deviation, and then we integrate them back to integrated series. They fall into very similar dynamics. You see that these jagged lines are the stable coins, but you see that the overall dynamics is actually very similar. So the idea that these are somehow interconnected is at hand when you look at it. So the question is, how really are these interconnected? Which one leads which one, or whether at all they lead each other, or they are just standardly correlated with the lag of zero. So we're interested in some causal inference between stablecoins and other crypto assets. So this leads us standardly in econometrics to vector autoregression or error correction models, or some non-stationary VAR. So mostly either VAR on first differences or the cointegration ECM model. So we apply Johansson tests and do the standard econometrics procedure on that to see what's happening. And as the capitalization is quite trending, and the trend doesn't seem to be linear, really, we opt for unrestricted trend cointegration that is suggested for these cases. And then we inspect both the short-term and long-term causality in this model. So as I said, we don't really have time to go through the tables and all the pictures. So I will now summarize the results and refer you to the preprint if you're interested. So first, the results suggest that stablecoins issuances or digital printing come after both Bitcoin and altcoin gains. So not before, but after. And the transmissions are rather strong at around 80% for Bitcoin and 50% for altcoins. And the effect in opposite direction, so from stablecoins coming to Bitcoin, so that the stablecoins are printed or let into the system, and only after that the other crypto assets would inflate in price. The effect is very weak, much weaker than the other way around, and only short-lived, and the transmission is around 4%. It's statistically significant, but economically it's much lower than the other way around. And the interpretation of such results is very conditional on the status and validity of stablecoins. So first, the first point there is that history of Tether has been quite controversial, because it was originally claimed that it's fully backed by the standard USD deposits, but it has never been properly audited. And its backing now also includes some loans to affiliate companies, which is not necessarily a problem, but it's not completely backed by cash. But still, the proportion of USDT being backed by USD is not really clear, even though there was a quite recent claim from last year that states that around 75% of USDT is backed by cash and cash equivalents. And the reality of being backed by standard currencies is quite crucial for some further interpretation of what is going on there. Because if Tether and other stablecoins are mostly, not necessarily fully backed, because even standard currencies are not fully backed by anything really, by other assets. The uncovered dynamics would really suggest that the growing prices of Bitcoin and altcoins lead to an increased demand for crypto assets, which is then projected into the increased demand of getting Tether. Okay. However, if stablecoins are issued from thin air, so if they're just being printed without any backing, so without any real demand behind that, the results of the presented analysis would imply that stablecoins are more used for boosting the already running bull run or increasing price trend with this newly printed money. But either way, the stablecoins issuances doesn't seem to be certainly the ignition point of the bull runs. Okay, and some previous studies suggest that this role was quite important during the 2017 rally, let's say. So we also focused on that one, but we didn't really find any evidence that there would be something wrong going on. The results are pretty much the same as for the overall period. So if the backing is valid and existent, then stablecoins influx signalizes an increased demand. That's important. If not, so if there is no backing and the stablecoins are created out of thin air, then it suggests that these are being used to boost or keep the trend going. But still, that doesn't mean that it's an ignition point. There is no evidence of some cyclical component or some boosting spiral that would be going on. So the results don't suggest that this is happening. Okay, and I'm getting close to the end when I check at least my clock. So I will just go to the very last point. So overall, the results suggest that the stable coins and growth in their issuance are mostly the reflection of an increasing demand for investment into crypto assets, rather than a boosting instruments for pricing rallies. So it actually goes quite against some kind of a popular belief that that Tether is mostly just a bubble boosting instrument. It doesn't seem that way, at least based on the data. If you're interested in the paper, it's on SSRN. So there is the link to that. There are some other Bitcoin or crypto assets related papers of mine if you're interested. And you know, if you're interested in something else, just write to me and we can have a chat. Thank you.
Thank you so much, Ladislav. Do we have any questions for Ladislav?
I have a question.
Go ahead.
Yeah, so in stable coins, it's quite popular nowadays, that you can lend it out for some interest rate. Have you tried to consider how this service could influence the price dynamics, since you can have some safe interest rate?
In stable coins, I'm actually not that aware of that. I know this is happening with other crypto assets, not really stable coins. I don't really see the point why you would do that, right? I mean, there is a 1-to-1 ratio between USDT and USD most of the time. I'm not sure. So it's some kind of staking in a way.
Yeah. So for example, for DAI from Maker,
for DAI,
you can put it. Yeah, you can put it on certain services where your money is just lent to other people, and you get some kind of interest rate. So I was curious if this could also.
Okay, yeah, that's a good point. I haven't considered that, because the thing is that like 95% of the capitalization is USDT, TUSD, and you know, all these standard copies of Tether, and these alternatives that are more about staking are just tiny portions. But to be honest, the staking and all the dynamics and motivations connected to that's I think a huge pool for research for the future, and it's pretty much, or it's very likely that it's future of crypto in general. So I think that's the way where the future research will certainly direct.
Thank you.
Thank you for the question.
Thank you, Michal, for the question, and thank you, Ladislav. We're getting close to the time, so I wanted to encourage everybody who has more questions for Ladislav to catch him at one of the breaks. And I wanted to thank you again, and wanted to ask if Jean-Baptiste Jouffray is in the room, and I assume
Yes.
that he will be presenting. Yes, so
I'm here.
our next talk is going to be on leverage points in the financial sector for seafood sustainability. And it is going to be presented by Jean-Baptiste Jouffray. So Jean-Baptiste, your
Thank you very much.
presentation is visible. We can see it.
Can you hear me?
Yes, we can
Yep.
hear you also very well. Go ahead.
Thanks a lot for the introduction. My name is Jean-Baptiste Jouffray. I'm a researcher at the Stockholm Resilience Center at Stockholm University. And today the topic of the talk will also be with finance, but maybe from a more naive perspective. So from like, imagine a natural scientist, which I am by training, diving into the world of finance and trying to understand what can be done with finance to improve sustainability. And I will start with this image that really captures what's going on today in the ocean. This is what we dubbed the blue acceleration in the spirit of the great acceleration work by Will Stephan and colleague. And it shows the exponential trajectory of human expansion into the ocean across a wide variety of sectors and globally. This is global data. And of course, when you see that, well, intuitively, you start thinking that, first of all, this is unlikely to add up in a sustainable fashion. Another thought is that to have that growth trajectory requires a lot of finance, a lot of capital that fuels this. You often hear about the ocean finance gap when it comes to blue economy narrative, but here there is no gap. There clearly is finance going there. And seafood is no exception to that trend. This is the wild capture and the aquaculture. And you can see that since the 1960s, aquaculture has been the world's fastest growing food sector. Rates of fish consumption have increased twice as rapidly as population growth, and fish has become one of the most traded food commodities. In 2018, global fish production, so both aquaculture and capture, reached an all-time high of 179 million tons. That supplies vital proteins and micronutrients to billions of people. The thing is, this does not come without a cost. And indeed, like there's more than 30% of the stock, the fish stock that are overfished, close to 60% of them are fully exploited, so there's no margin to increase, and only less than 10% of them are able to, what is referred to as underexploited. And of course, the sector is plagued with unsustainable practices, ranging from illegal fishing and habitat destruction to overuse of antibiotics in farming and forced labor, like occasion and cases of forced and child labor in seafood. So making sure that seafood is socially and environmentally sustainable has therefore become a key concern for industry, governments, and the general public alike. And that's where finance comes in. So could finance contribute to seafood sustainability? We've heard about like initiative from government, from civil societies, but increasingly there is this momentum about green finance or the role of finance to use its power to incentivize sustainability. And if you look at the literature, there's quite a bit when it comes to finance and agri-food and the agriculture system. And you will find like finance and the role of transformation in the agri-food supply chain, this idea of finance for agriculture or agriculture for finance, and so on. And there is like that a couple of papers up to this dialogue on why ecologists should care about financial markets, published a couple of years ago, and the response about why finance should care about ecology. But when it comes to seafood specifically, most of the literature so far has focused on public finance, which is the role of subsidies. So the need to put an end to harmful subsidies. And on the other hand, on impact investment or development finance. So how can we favor like impact investment? But there hasn't been real discussion about the role of the actual financial sector in that. And this is what our paper addressed. It was published like short of a year ago, last fall. And it really is about understanding how the financial sector interacts with the seafood industry and where sustainability leverage points may lie. And by leverage point, we mean where in the system can a small change trigger a bigger change, a systemic change. And to do that, not coming from a financial background myself, even though some of my co-authors did, really went back to the basis to try to understand what were the interaction between financial sector and seafood. And so using mixed method approach that combine content analysis of like fishing news media, a lot of newspaper, but fishing industry, qualitative examples of some case studies of iconic examples of finance and seafood, and then quantitative analysis of specifically the network of shareholders of publicly listed companies. And put all together, we identify three main leverage points. First one is about banks, then stock exchanges, and then shareholders. We found the two most promising levers to be the bank and the stock exchange, and shareholder activism is a less powerful force than might be expected, and I will elaborate on why so. So first, let's start with banks. Banks are quite fascinating because they hold great potential for promoting sustainability, given their ability to monitor companies in detail and especially to tailor loan terms. So regardless of a firm's ownership structure, whether the company is public or private, bank loans dominate external financing in the world's major economies. And they are therefore essential to the operation of seafood companies. So more than half of external financing that a company will receive will come from bank loans. And loans comes with what is called covenants, which are agreements between the bank and the borrower, stipulating what the borrower can or cannot do. And so if you are to start incorporating sustainability criteria into your loan covenant and binding companies to sustainable practices, then of course banks could play a prominent role in accelerating transformation towards more sustainable practices. A recent example of that is in 2019, for instance, the agriculture giant company Louis Dreyfus agreed with its lenders 750 million loans for which the interest rate is coupled with the company's sustainability performance, as measured in that case by a reduction in its carbon dioxide emissions, electricity consumption, water usage, and solid waste. So if the sustainability rating goes up, the interest rate goes down, and vice versa. So in other words, it's a big incentive for the companies to become more sustainable and have better practices to have lower interest rate. And we have a few examples of that, but they're rather the exception. The second leverage point we identify is stock exchanges. So to open its ownership to the public, a firm must get listed on a stock exchange. And companies do so to access capital, to gain exposure to broader markets, and enhance their brand reputation. And that creates another opportunity to scrutinize firm and takes sustainability into consideration. Why is that? Is because stock exchange can act as some kind of a regulatory body through their listing requirements. So every stock exchange has a list of what they call listing rules that a company needs to comply with at the time of listing, but also on an annual basis once it's listed. And again, if you were to incorporate sustainability criteria within those listing requirements, which today focuses mostly on financial requirement, then you could force somehow push companies to be more sustainable. When it's particularly interesting in the seafood sector is because most large publicly listed seafood companies are listed on just a handful of stock exchanges. Specifically, the Tokyo Stock Exchange alone concentrates 53% of the combined revenue of the largest 45 publicly listed seafood company in the world. And if you consider the 4 largest exchanges in the seafood industry, so the Tokyo, the Oslo, Korea, and Thailand Stock Exchange, together those 4 stock exchanges account for 86% of the combined revenue. They concentrate those companies. So in other words, if you were to change the listing rules of just those 4 stock exchanges, you would have a dramatic impact on the whole seafood industry, at least the publicly listed side of it. Finally, shareholder activism. That's one that's quite intuitive. It's like once a company gets listed on a stock exchange, an investor impact on corporate decision is determined by its percentage of stock ownership. And so that gives a share of voting rights. So usually it's assumed that if you own more than 5% in a company, you become what is referred to as a block holder. So you have influence enough and enough share, enough voice to actually influence the governance and the operation of the company by your vote. And this is something that often makes the headlines in the news, like the power of investors on shareholders like you or me or other companies or financial institutions themselves that are shareholders to influence corporate governance through shareholding. And it does indeed represent an important way to affect company policies. But in the seafood, interestingly, it might be more limited than one thing. First of all, most of seafood companies are actually privately owned. So if you look at the top 100 seafood companies in the world, roughly half of them are publicly listed, but 53 of them are privately owned. So there is no impact of shareholder at that stage. Then if you look at the network of shareholders, and that's what we did. So we looked at we investigated 3,000 shareholders of 160 seafood publicly listed companies. It looks like that. It looks extremely modular. So in other words, and the percentage above the graph are for the respective share ownership. So share above 5% and shares above 10%. And what you see is that most large fishing and aquaculture firms are privately owned. And in the publicly listed ones, no single investor has substantial shares across many different companies. So that is to say that what you could have hoped is that like a key node in the network, that if you go to that shareholder and start influencing that, this shareholder would have an influence across the whole network. But it's not the case. Each company has just its own cohort of shareholders. Now, when you look at the nature of the shareholders, it further reveals that the proportion accounted for by financial institutions, like banks, for instance, or private equity or assets manager, decreases as the ownership share increases. And that's the panel on the left hand that you can see here. So again, ownership share, as soon as you have shareholders with more than 5% ownership, you see that the proportion that is financial institution decreases, and instead individuals like you and me and non-financial corporations, so other companies, which is a pattern of cross ownership, increase dramatically up to the point even more for shares above 10%. At the same time, what you see on the right hand is that financial institutions are still the type of investors, the type of shareholders that invest most capital into the sector. So there's a little bit of a paradox here, which says that basically it's a pattern of institutional shareholders injecting large amount of capital into the seafood industry, but with very little stake in any one company. So if you may, it's some kind of dilution of responsibility. So to conclude, can finance contribute to seafood sustainability? The answer is yes, absolutely. And more than looking at innovative financial instruments or like this new derivatives form, the mechanisms are already in place and they exist, and they're more traditional than one would think. There's a but though. And the but is that as long as financial institutions do not realize that social and ecological risk translate into financial risk, they are unlikely to be willing to transform their own practices. So it's really important to manage to translate that risk. Seafood companies, on their hand, need to disclose their non-financial activities and performance and be independently audited. That should be incentivized by governments to enforce this type of reporting. And all of that is in the hope that sustainable finance move from becoming on the margin and becoming the exception to becoming the norm. Thank you very much.
Thank you, Jean-Baptiste. Very interesting. Do we have any questions for Jean-Baptiste? Anybody? I have a question. Maybe you mentioned it, but how do you actually measure the sustainability of the seafood industry?
That's a difficult one. And if I had the answer, I probably wouldn't be there. But essentially, that is up for discussion. And that's a really good point, because you need metrics, right? And the financial sector in particular needs those metrics. For climate, it's becoming increasingly mainstream because of carbon emission, of CO2 equivalent. There is no such easy metric for seafood, but you do have a range of them. And essentially, they link to traceability and transparency. So crucial to the sustainability in the seafood industry is the idea that you can trace your product and you can know where it was fished, within which quotas, and for what purpose. And then, of course, you could look at emission from fishing vessels or from farm, pollution, so the effluent from the farm. So that you have a range of parameters to look at, and it's increasingly becoming the norm for some third party like Sustainalytics or Cicero, who actually provide information on those aspects.
Right. Yeah. It's to be continued, the discussion.
Thank you very much.
On a worldwide level. So, but thank you again. And I'd like to move on to our third presenter for the session. I assume that's going to be Konstantinos Papastamatiou. There are three authors of the paper. So Konstantinos, if you could share your screen. Konstantinos is going to talk about implementation of singular spectrum analysis and convergence cross-mapping algorithm in financial time series. So Konstantinos, the floor is yours.
Thank you very much. I will start sharing my screen.
We can hear you, but we still do not see your screen. Now we can, yes, but and we can hear you well. Perfect. Go ahead.
Okay. So I have a pre-recorded presentation. If I can play it for you.
Mm-hmm. I'm not sure if there was supposed to be sound already, but we do not hear the sound.
You do not hear the sound?
No.
Oh, sorry, just a minute.
There is a way to share audio, and I think you should do that so that everybody can hear the sound of the presentation.
Sorry, there was a problem with the connection.
Okay.
Okay. Now do you hear the sound?
Yes.
Okay.
Good evening to everyone. The theme of our research, as referred in the title, is the implementation of singular spectrum analysis and convergent cross-mapping algorithm in the financial time series. My name is Konstantinos Papastamatiou, and I will be the presenter of our work. We are here to present you a part of our research considering the exploration of financial time series. The question we came to address is whether financial time series are a product of a random procedure or they contain deterministic chaos. In the present work, we have examined two of the most pronounced indexes of the New York Stock Exchange, the SP 500 and the volatility index for the period of 2000 to the end of 2019, consisting of 5,016 daily observations. Our goal is, apart from the nature of their structure, to explore the possibility of a non-linear causality between these indexes. On the top left corner, we have the plot of the SP 500 index, and on the bottom left, we have the daily logarithmic returns of the same period. To avoid the trend and the bias that came along with it, we continued our research with the log returns of the index values. In order to proceed with our analysis, we constructed the periodogram of the log returns using both Pgram and AR method. On the table, in the bottom right corner, we provide the dominant daily cycles by high importance. The periodogram, which was constructed using a window of 2000 daily observations, is a crucial element in order to continue with the singular spectrum analysis. So, what is singular spectrum analysis and what can it tell us about our time series? This is a data-based method without an ex-ante theoretical hypothesis considering the origin of the abnormality. The method used in the present content is the Toplitz's SSA as it suited better in our dataset. With this method, we deconstruct the time series into datasets, one containing the structure variation data in a signal form and the other with the unstructured variation noisy data. The SSA is a three-step procedure consisting with matrix decomposition, grouping, time series reconstruction. The SSA provides a number of benefits beyond filtering noise. It may ease non-stationarity by allowing us to remove slow-moving trend components that may be at the root of our problem. It measures signal strength so that we can make an informed decision regarding whether to continue searching for deterministic structure in the observed data series. Finally, SSA can be applied to fill the intermittent missing observations in observed data. It does so by using the structure variation in the entire time series rather than relying solely on immediately surrounding observation, as do moving average method approaches. The first visual diagnostic is the Eigen Spectrum, which plots the square roots of the eigenvalues in the Eigen triplets in descending magnitude. The Eigen Spectrum typically has a hockey stick appearance. The rule of thumb is that singular values along the steep portion of the Eigen Spectrum are associated with Eigen triplets, forming the basis of the deterministic signal. Successive singular values that are equal create steps in the steep portion. Each step represents eigentriplet pairs, forming the basis of the deterministic signal. Successive singular values that are equal create steps in the steep portion. Each step represents eigentriplet pairs, forming the basis of potential harmonic oscillations in the signal. Singular values along the flat portion of the Eigen spectrum are associated with a noise component. The Eigen spectrum of the SP500 return data has the expected hockey stick appearance, with steps at paired singular values 1, 2, 3, 4, and 5, 6 along the steep portion of the plot. The second visual diagnostic plots eigenvectors corresponding the singular values along the Eigen spectrum. Each eigenvector is the time series representation of the dynamics captured in the corresponding eigentriplet. Paired eigenvectors associated with potential harmonic oscillations oscillate with identical frequency in phase quadrature. The paired eigenvectors associated with the potential harmonic oscillations in the SP500 log return eigenspectrum 1, 2, 3, 4, and 5, 6 oscillate at the identical frequency in phase quadrature, providing rather evidence for the harmonics. The third visual diagnostic shows scatter plots of successive paired eigenvectors corresponding to singular values along the Eigen spectrum. Scatter plots of successive eigenvectors associated with potential harmonic oscillations result in polygons whose numbers of sides indicate the oscillation period. A final diagnostic of W correlation plot, which shows weighted correlations between decomposed matrices after they have been converted to time series with diagonal average. If the W correlation between the two eigentriplets is low, they are deemed to be statistically independent and separable into different grouping. Alternative, if the W correlation is high, the eigentriplets are non-separable and should not be grouped apart. The W correlation plot has the eigentriplets along its axis in rank order of their corresponding singular values. Conventionally, darker shading is used to reflect higher W correlation. The diagonal of the plot is black because eigentriplets are perfectly correlated with themselves. In order to check the null hypothesis that our dataset is a product of a linear stochastic procedure, we conducted a PPS surrogate test with the algorithm formulated by Small and Che. The PPS algorithm implements a random walk over a reconstructed shadow attractor and takes as a surrogate data vector the first coordinates of the randomly selected points on the attractor. Consequently, PPS surrogates preserve coerced deterministic features, example periodic trends, but destroy fine structure, example deterministic house. As shown in the result placed in the table on this slide, we can see that the null hypothesis is rejected for the most of the metrics used. With the use of nonlinear T-series library in our programming language, which is based on TCN, we made our next day prediction. As shown by the results and the value of the Nash such-leaf error criterion, whose value is 0.9, we managed to get a very good approximation for the next day return. Here we have to notice that if we extend the time period, the value of the NSE drops dramatically, making the predictions practically useless. Following the form from the analysis of the SP500 index, we continue with the VIX index. As it can be clearly seen from the periodogram, there is no dominant frequency. The result from the PPS surrogate test rejects the null hypothesis in a significant level of 5%, and so we can conclude that our time series is not a product of a linear stochastic process. In this slide, we can see the next day prediction of VIX index. The NSE is equal to 0.895, which is a modest number, so as to make our assumption validate. Now we present the CCM method, which tests for causal interactions between variables that have continuous records and are generated by deterministic, low-dimensional, and non-linear dynamics. Sugihara developed CCM to detect causal networks in real-world systems diagnosed by deterministic, low-dimensional, and non-linear dynamics. CCM tests whether there is any correspondence between phase spaces reconstructed from observed time series variables. If X and Y interact in the same dynamical system, then attractors reconstructed with delayed X coordinates, Mx, or delayed with Y coordinates, My, map one-to-one to the original system attractor M, and consequently map one-to-one to each other. Variable Y is found to causal drive X if Mx can be used to skillfully cross-map points on My. The results of the method used can be seen in the figure of the slide. As we can observe, the correlation between the S&P index, which in this case stands for the forcing variable, and the VIX index, which stands for the response variable, are in a level of a zero-time lag causality. The picture, if we revert the state of the variable, is now completely different, as no cause seems to emerge between the VIX and the SP500 series. As far as the results concerned, we have managed to determine that there is no significant contribution of a periodic effect in the form of our time series of the returns. This might have to do with the fact that the selected period is not a homogeneous one, as it contains financial bubble and the Great Recession of 2008. By the test conducted, we have also shown that these time series are not the product of a linear stochastic process, but there were also not significant evidence to back the hypothesis that there is a low-dimensional deterministic chaotic behavior. In our future project, we will try to define and separate the periods with different characteristics in order to investigate whether or not low-dimensional chaos can define them. Thank you for your attention.
Thank you so much, Konstantinos. Do we have any questions for Konstantinos? Kostas, did you have a question? I see you unmuted your microphone, but we cannot hear you.
No, it's me, the presenter.
Ah, okay. So, anybody, any questions for Costa?
Well, I might just ask on the last point in his conclusions, what are his plans for the future to determine this more deterministic, this chaos? If he can say us something.
Yes, my plan is to try to find, as Sornet says, when a financial bubble emerges, there is a high interaction and synchronization between the agents in the stock market. So I tried to specify those periods in order to find where this high level of synchronization emerges, and then to try to see if in these periods also deterministic low-dimensional chaotic behavior emerges too.
And so are you planning to follow his procedure? But I'm asking what are you adding as new studies?
What I am adding is that I'm trying to implement a new type of synchronization in the financial finding the synchronization in the financial markets with the use of non-linear optimization, like the Kuramoto model.
Mm-hmm.
Okay,
Okay.
thank you. Thank you.
Great. Thank you so much. And we're right on time, ready for the next talk. Thank you, Costa, and thank you, Tiziana, for the question. So I'd like to invite the next presenter, who is going to talk about the origins of extreme wealth inequality in the talent versus luck model. And
yes, I'm here.
So Andrea?
Yes.
Rapisarda, okay. So would you please share your screen, Andrea?
Yes.
Great. So you will have 12 minutes and we'll have some time for questions and answers. Andrea, go ahead.
Okay. So I will present some new results about the origin of extreme wealth inequality in the talent versus luck model, which is a model that we introduced 2 years ago. This is the paper. The paper was published in 2018 together with Alessandro Pluchino and Alessio Emanuele Biondo in Catania. And the paper was very popular. You can see here how many times it was downloaded, and the altmetric score is quite high. And so it was very interesting to understand the dynamics of this model more in detail. Actually, okay, this is the social media impact that this model has had. And so when we presented 2 years ago this model at the Econofisico colloquium in Palermo, Damien Challet made some questions, and for him it was quite easy to understand the dynamics, but I will show you that this is not the case. He joined our team and we investigated more in detail the dynamics. The paper was published just this year. Luck is very important, not only in life, but also in science. You may know that serendipity is discovery by chance, and most of you know that 90% of discoveries are just by chance. One example is the one of penicillin by Alexander Fleming, who discovered it just because he left his windows open during a vacation, and when he came back, this spore of penicillium just killed some bacteria in his petri dish, but he was so smart to realize that this was good, and so he got the Nobel Prize in 1945. A more recent example, okay, he was doubly lucky because someone before him, 35 years before Fleming, discovered the same penicillin by chance, but he was an unknown young doctor in Naples, and he published this result, but no one noted it, and so this was forgotten. Another example, more recent, is the one of graphene that was discovered in one of out of the box crazy experiment that these two guys, Game and Novoselov, made during the weekends, and just playing with a pencil and some scotch, they discovered this single layer of carbon, which is such a fantastic material, very much studied today. So, well, another important example is this one that is taken from a paper that was published by Fortunato and collaborators few years ago, in which they showed that the most popular paper can happen at the beginning of your career, like it was for a Witzek, or in the middle for Segre, or at the end for a Roche, but the probability to publish the top paper is just the same. So it's just a matter of chance. So then let me recap the fundamental ingredients of our model, the first one, and we started from two well-known facts. The first one is that human intelligence has a Gaussian distribution, like many human features, and but the distribution of wealth was discovered by Pareto is a power law, and the same for fame and for many other things. So how can we combine these two things? That there is no one guy which is very much more intelligent than me, but is much more famous or richer. So we imagine to have this kind of dynamics. We imagine to have 1,000 agents that work for 40 years. They have a normal distribution of talent, which includes intelligence, hard working, and many qualities that one could have. And they encounter lucky and unlucky events during their career. We check every 6 months, and we give them 10 units of capital, and this capital can be increased or decreased with a certain law that now I explain, according to the fact that they have lucky or unlucky events. So if they encounter lucky events, they double their initial capital with a probability which is proportional to the talent of that person, of that agent. So they profit of that good opportunity, but they can have also bad accidents, so they can encounter unlucky events, and in this case they halve the capital. So if you imagine this, we made this simple model. This is our world where these agents live, and they encounter these lucky and unlucky events, and they have a normal distribution of talent. And this is the first result, which is quite strange at first sight, but it's what we observe actually in real life. That is that capital is not proportional to your talent. And in fact, those agents who are the most famous or the richest after the end of the one run are not the most talented, but are the one that got the maximum of success or richness are those who have a talent which is slightly over the average of our talent distribution. We can repeat this many times, and you get always the same results. This is on the bottom is just the richest agents after the simulation for all the 100 runs, and this is the distribution of wealth that you get at the end. So it's a power law with a slope of minus 1.3, which is what is mostly observed. This is the distribution of the final distribution for 10,000 runs, and you see that even in this case we have a kind of a Gaussian distribution, but the peak is just slightly above the average talent. Okay, then Damien Challet came in, and we tried to understand more in detail these dynamics, and we simplified the models because although the model is simple, it's not that simple to solve it analytically. And so we consider only lucky events. And even if you consider only lucky events, you can get a distribution of probability of having a capital greater than a certain quantity C, which is a power law, as is shown in this plot. And the probability of the number of lucky events that occur to these agents is more and more Gaussian as you increase the number of events. Here, this is not very realistic, but in order to have some kind of a stable asymptotic results, we just increased these numbers. And you see also in these QQ plots in the bottom that this is more and more Gaussian as you increase the number of events of this for this PN. But you should consider also this probability distribution PK, which is the number of probability of transforming into these lucky events into something that make your capital increase. Okay. And this is not Gaussian. This is show some deviation from normal behavior. Okay, so you can go into a more analytical treatment, and you can see that this probability PKT is a binomial distribution, which actually can be approximated by a Gaussian distribution, and this is more and more true as you increase the total number of time step and the lucky events. So in the end, what you get is that this PC is given by 1 over C P log 2C. And so in order to have a heavy tail, fat tails, you should have this PK that decrease as exponentially, and in this case, PC is a power law, or it should be a Gaussian, and in this case, PC is log normal, which, as we know, is not that different. I mean, it's difficult to distinguish from a power law. So this is the first case that we examined. Suppose that you give a homogeneous distribution of talent to all agents in order to simplify things. And in this case, it is possible to see that this PK is normal, so PC is log normal. And then Monte Carlo simulation that we can do agree very well with the theoretical curve. You can also explore the case of heterogeneous but uniform distribution of talent to agents. And in this case, it is possible to see that the tail of PK is exponential, so PC is a power law. Okay. So to conclude, the main reasons for the emergence of heavy tail in this simplified talent versus luck model is the coupling of a multiplicative process for the capital dynamics to a stochastic occurrence of luck events. The final capital distribution is log normal when talent is the same for all agents, but a small heterogeneity in the talent makes this final distribution more complex, and in the end you get a power law. Of course, increasing this heterogeneity increases also the difficulty in solving this dynamics analytically, and in particular if you include also the unlucky events. So although this dynamics may seem quite simple, it's not that simple to be understood analytically. Okay, so this is, for those who are interested, this is the web page, the official web page of the project, and which you can find at this link. And thank you for your attention and good luck.
Thank you so much, Andrea, for this very exciting presentation. So do we have any questions for Andrea?
Okay, I have a question. Two comments, may I?
Yes, of course. Go ahead, Czeslaw.
I liked very much the formal aspects of this, but since I have a more multidisciplinary approach, understanding society and mathematics, I have two comments. It seems to me, once again, formally this is perfect, but it seems somehow intuitive that the results, it will take much more time to discuss it from, let's say, phenomenological point of view, it seems somehow intuitive, you know, that we could, there's a talent, what these talented people lack because of the number and so on. So this is my first comment. My second phenomenological comment, but it was in the last line of the conclusions, that as a matter of fact, you have an assumption that talent is independent from the context in the model, in the systemic terms, and luck is systemic. And in this case, it makes mathematics nicer, but the phenomenology somehow is, let's say, impoverished. Of course, once again, I don't criticize it, but I find it is very inspiring. But what is needed is more societal phenomenology. Thank you very much.
Thank you, Czeslaw, for the comment. There is another question in the chat. I'm going to read it to you, Andrea.
Yes.
It's about the multiplicative capital dynamics, and if that causes the results, the question is, have you tried different lucky-unlucky dynamics, such as additive?
Yes, but with additive, it doesn't work. I mean, you need, in order to have a power law distribution, you need to have a multiplicative dynamics. This is for sure. Okay, you can imagine more complicated dynamics, but we started with this because it's the simplest that one can imagine. And usually the simplest is the one that is closest to reality. Of course, I am forgetting many details, many things that in reality could be important. But I think that this multiplicative dynamics is a fundamental key in order to understand why we observe so many power laws of this kind. And of course, luck is something that we cannot control, okay? And it's everywhere. Talent, I can be talented, but I live in the desert. And so who cares? I will never be famous or rich because I don't meet any opportunity in the desert. So I mean, that's the point. That's why people live in cities, because there are more opportunities to meet people and to encounter a good chance. I mean,
great. Thank you so much, Andrea. And we are ready to go to our final talk for the session. And I'd like to invite Sebastiaan Thielman to share your screen, Sebastiaan. And Sebastiaan is going to talk about methodological insights into the validation of agent-based models in macroeconomics. So Sebastiaan, we can see your screen.
Yeah, thank you.
And we can hear you, so go ahead.
Yeah, I have a pre-recorded PowerPoint.
Okay.
So I hope this works.
We cannot hear the sound.
No, it doesn't play. Well, can you see the slide though?
We can see the slides, yes.
Okay, then if it's okay, I will just do it in this way.
Of course, go ahead.
Okay, so thank you everybody for joining me for this presentation. Wait, just 1 second, please.
Sure.
Okay, so today I'll be presenting this paper called Methodological Insights into the Validation of Agent-Based Models. So first, to give you a quick introduction. So for a long time, the dynamic stochastic general equilibrium models have been dominant in macroeconomics. But this changed a bit since the economic crisis of 2002, because there was severe critique on the DSGE framework. And basically, one of the reasons for this was that the DSGE framework makes use of ex-ante equilibrium assumptions, which basically mean that crises can only be put into the model in an exogenous way. And yeah, this implies that the model is not really explaining why economic crises occur. So this is a problem for this type of models. And macroeconomic agent-based models have since been considered as a solution to this problem. But one of the things that has hampered the adoption of macroeconomic agent-based models has been concerns regarding the validation of agent-based models. So the research question of this paper is to kind of provide a deeper understanding of how macroeconomic agent-based models, in the way that they are validated in practice, how this enhances the validity of these models. And also to kind of come to a characterization of macroeconomic agent-based models in the light of this validation practice. And to do this, I connect three frameworks. First, I'll talk briefly a bit about model validation in general, then about the difference between target and mechanism validation, and then I will go into the relationship between validation, complexity, and emergence. So first, what is model validation? Yeah, so first, it is important to say something about how we define a model. There are many ways to talk about models, but the way that I'll use in this paper is a model as a computational experiment in which models are tools to answer questions. And models are also specifically constructed to answer a question. And models answer questions by isolating certain relevant elements of reality. So basically they highlight the elements that we deem are essential for answering the question posed. And validation then becomes the assessment of a model's capability to answer a question in a correct way. And in this paper, I will be talking more specifically about empirical validation, which is the assessment of a model's answer to a question through its correspondence with relevant empirical reality. Yeah, so I will now talk about black, white, and gray box models, which is related to the difference between target and mechanism validation. So models are generally constituted by mechanisms and a model target. The model target is the intended phenomenon to reproduce, while the model mechanisms are the relationships between model entities by which the target is reproduced. So for example, if we want a model to explain business cycles, then the target of the model is the business cycle, and the model mechanisms are the mechanisms that are in place. Maybe it's the relationships between consumers and firms by which this business cycle is produced. And what is crucial now is that models differ in terms of whether and how mechanisms are validated. So in general, we can distinguish three types of empirical validation tests. There's target validation, which is comparing model output to empirical data of the model target. So in this case, a model that is built to reproduce the business cycle, we can check whether the cycle reproduced by the model matches the one we observe empirically. Then there's direct mechanism validation, which is a direct comparison with the individual relationships between the model entities and the empirical data. So if we have a business cycle that is generated through the interaction between consumers and firms, just to give a random example, then we can check, okay, is this relationship that we have built into the model, is this actually how we observe this interaction empirically? Then finally, there's indirect model mechanism validation, which is comparing a wide range of model outputs to empirical data. So this is not when we are actually directly assessing the model mechanisms, but rather we take a very broad range of model output and we compare this to empirical data. And this is a bit like a Turing test. So we basically ask the model questions to which we have well-known answers. And this kind of builds trust into the model mechanisms without actually assessing the model mechanisms in a direct way. So from this categorization of three types of tests, we can go into three types of models. So there's black box models in which only the output is of interest and there only target validation applies. There's white box models in which the mechanisms and the target are of interest, in which basically all three types of tests may apply. And finally, there's gray box models in which the mechanisms and the target are of interest, but direct validation is either not required or it is not feasible. And later I'll talk a bit about why it may not be feasible. And in this case, only target and indirect validation apply. So now let me talk a bit about complex systems and validation in practice. So we can think of emergence and levels in a complex system. And I have used this definition here of what is an emergent phenomenon. So this in this equation here, we can see S, which are the structures of the model, and then we have int, which are the interactions, and finally an observation mechanism. And then we can say that a phenomenon P is emergent if we see it at the level n+1, but we do not observe it at the level that is below that. Right, so we have agents that are kind of this base level in an agent-based model, for example, and they are this level n. And through interaction, they form kind of new structures, which is this n+1. And if we observe phenomenon at this higher level, which we do not observe at level n, then we can say that this phenomenon is emergent. So for agent-based models and macroeconomic agent-based models, often we will be able to distinguish this agent level, this meso level, and this macro level. And some meso and macroeconomic properties are emergent with respect to the agent level input. Importantly, however, the properties of the agent at S1 are different from, but provide input to the higher levels. Right, so the higher levels of structures are not completely independent from this agent level, but they are different from them. Yeah, so now emergence and validation of ABMs. So the mechanisms at the agent level are generally validated directly in macroeconomic agent-based models. So, and we can see this by the fact that usually the behavior in a macroeconomic agent-based model is motivated by evidence from economic experiments, for example. So this is really a direct assessment. Okay, is this agent behaving like we observe it in the laboratory, for example? But the emergent higher level mechanisms are only validated indirectly. And this is really a consequence of the simulation methodology. Because we do not observe these higher level mechanisms in an analytical way. We can only assess their output through simulation. And as a consequence of this, ABMs are generally validated using kind of a wide range of stylized facts. And this is this indirect validation, which builds trust in these higher level mechanisms. Yeah, so this is a brief schematic overview. So you can imagine the circles and squares as the agents, and they have certain interactions. And with that, they form a new structure S2. And these new mesostructures, they can have interactions, and in total, they will form the macroeconomy as a whole. So just as a brief example, so I use this paper, agent-based macroeconomics, a baseline model. And this paper also asks, okay, what generates macroeconomic instabilities? So first you have an agent level where households have an employment connection with firms, and they have a consumer connection with firms, and they all follow simple behavioral rules. So this is really this base level, which is usually motivated in a direct way. And then at the meso level, we can see, for example, the distribution of firm size. And this is these graphs here are used to validate the model. So these are really the direct consequence of these interactions of the agent, but they are, of course, output. So here we are already talking about indirect validation. And at the macro level, this also happens. So for example, in the bottom right panel, this is kind of the cycle that is generated by the model. And this is, of course, this model target that is then validated. But also a wider range of macroeconomic stylized facts is used to validate this, the model mechanisms in an indirect way. So my conclusion is that macroeconomic agent-based models can be characterized as gray box models because still a large part of their validation is happening in this indirect way, which is a consequence of the simulation methodology, where a lot of these higher order mechanisms cannot be validated directly, but they are built from white boxes, which are of course the agents, and these are validated in a more direct way.
Okay, thank you, Sebastiaan. Do we have any questions for Sebastiaan? I assume this question, can we read more about your research somewhere? Any published formats? It is for Sebastiaan? Joel?
So I'm still waiting on some confirmations for its publication. Thank you.
Okay, great. Okay, thank you everybody for participating in this session, and thank you to the presenters, especially, and the questions. So I'd like to conclude the session. It's right on time, so I would invite everybody to keep networking during the breakout sessions, and I look forward to seeing you around. Thank you all, and have a great rest of the day.
Thank you very much. Thank you. Bye, Irene. Bye, everybody.
Goodbye.
Bless you, whoever sneezed. Bye-bye.